Okay, please settle down fast. Now having discussion from question number 6 to question number 12. So open the sheet, come to the second page. Starting with Honor Wagner, a student at the University of Canterbury, New Zealand, has been asked to prepare a presentation on foreign exchange rates for his international business course. Wagner has a basic understanding of exchange rates but would like a practitioner's perspective, and he has arranged an interview with currency trader Hannah McFadden. During the interview, Wagner asked McFadden, so first paragraph is not relevant for us, it is just a starting of story, okay? Now discussion will start here. Could you explain what drives exchange rates? I am curious as to why our New Zealand dollar was affected by the European debt crisis in 2011 and what other factors impact it. In response, McFadden begins with a general discussion of exchange rates. She notes that international parity conditions illustrate how exchange rates are linked to expected inflation, interest rate differences, and forward exchange rates, as well as current and expected future spot rates. So these out of which few factors we have already seen in our practical. Interest rate parity we have seen already, covered and uncovered both. Okay? In response, McFadden begins with a general, we have read this. Statement number 1. Fortunately, the international parity condition most relevant for forex carry trade does not always hold. Okay, stop reading now. Jump to question number 6. Name the international parity condition McFadden is referring to in statement number 1. So if we want to conduct a carry trade operations, as we saw in our practical, we were using interest rate parity for conducting carry trade operations, for doing money market operations. We were using interest rate parity. Remember that question, euro and US dollar? We borrowed in US dollar and we made an investment in euro. Okay, so that is related with interest rate parity. And interest rate parity is suggesting what? Borrow the money where the rate of interest is less. Then convert the currency after borrowing, okay, in the other currency where you want to make an investment. Where you will make investment? In the country where the interest rate is higher. So in that question, interest rate was high in euro, 2.2%. Okay, and then investments will get mature, and after that you have to convert the maturity value again in terms of the initial currency, and then compare what is the benefit for you. So that was all related with interest rate parity, and we already understood that the country where the interest rate is less, the currency of such country will be at premium. Okay, so far as forward rate is concerned, the currency will be at premium where the interest rate is less, and where the interest rate is more, currency will be at discount. so far as forward rate is concerned. This we have learned by interest rate parity condition. It's clear?
Yes.
Okay. So then now move to next paragraph. So question number 6 we have done now. Okay, clear? Then McFadden continues her discussion. Forex carry traders go long, that is buy high yield currencies, and fund their position by shorting, that is borrowing in low yield currency. We also did the same. We borrowed US dollar because the rate of interest was less in US, and we made an investment in euro currency because the rate of interest was higher. Is it clear? Unfortunately, crashes in currency value can occur, which creates financial crisis as traders unwind their positions. For example, in 2008, the New Zealand dollar was negatively impacted when highly leveraged carry trades were unwound. In addition to investors, consumers and business owners can also affect currency exchange rates through their impact on their country's balance of payment. For example, if New Zealand consumers purchase more goods from China and New Zealand business sells to China, New Zealand will run a trade account deficits with China. Stop reading. This paragraph is related with question number 7. Come to question number 7. In statement 2, what McFadden is most failing to consider. So basically what is happening, what he said to us, he said that about reasons behind financial crisis and all those things he discussed. He said that in the second or third line he said, for example, in 2008, the New Zealand dollar was negatively impacted when highly leveraged carry trades were unwound. Unwound means uncovered. It means you borrowed US dollar, you converted it into euro, you made an investment in euro, but when the investment gets matured in euro, you did not book a forward contract. You just kept your position open in air. Whatever will be the exchange rate after 1 year, we will see, and we will convert our euro into US dollar at that rate. And by the time crisis happened and the foreign exchange rate was not in favor for you, and that is why losses happened to you, heavy losses, and that is why currency crisis happened. Is it clear?
So you should always book a forward contract?
Preferable, at least to avoid risk. Okay? Is it clear?
Yeah.
So what he said after that, he said that many a times trade deficit means what? Your import is more than the export. That is called trade deficit. Okay? Trade deficit usually bringing the depreciation in the currency. How it is depreciating? Your export is becoming more competitive than others. Means the other countries are exporting products to importer at a less rate, and you are quoting the higher price, and that is why your export becoming more competitive. And at the same time, your import is becoming more expensive because your currency value has depreciated. So you have to pay more money to get import. Is it clear?
Yes.
So these are the two reasons. trade deficits always depreciating currency value of the country.
That's
Okay?
why best case when currency unstable.
Unstable, yeah. And the other thing is that in the third part of this paragraph, he said that many a times, trade imbalance offsetting the prices of the products and services, and automatically the import and exports are getting adjusted. But it's not the case. Many of the researches took place and it showed us the result that there is a long lag between changes in forex and prices of the products and services and trade balance. It means it's not a what we call it. Let's say the forex price has been changed drastically today. So immediately it will not impact the prices of the product and goods. Immediately it will not impact the balance of trade. It will take a longer time to adjust the prices of the product and services and balance of trade. Immediately people will not stop exporting and importing. Immediately people will not increase or decrease the prices of the product and services. Because forex prices, in a day, many a times it is fluctuating. So all the times it's not possible to change the prices of the products and services, and always it is not possible to adjust the balance of trade, increase or decrease import and export. It is a long lag between these two things. If permanently the forex price is getting changed, then gradually the prices of the products and services are getting adjusted according to foreign exchange price, and balance of trade getting adjusted according to foreign exchange price. Is it clear? Suppose if Uzbek som is getting cheaper than US dollar more permanently, then if you import something from US dollar, then it will cost you more, because here currency depreciates. Okay, so it will cost you more. You have to pay more Uzbek som to buy $1. So what you will do in a long run way? You will reduce your import from US. Is it clear? So this is how the people are getting adjusted in a long run way, but not immediately. Immediately, the changes in forex rates, reflecting the changes in investment and financing decision, but not balance of trade and prices of goods and services. It's not getting adjusted immediately. It takes time. There is a long lag between these two things. Okay? Is it clear? So this is the answer for question number 7. Now come to next paragraph. McFadden further explains statement number 2. A trade surplus will tend to cause the currency of the country in surplus to appreciate, while a deficit will cause currency depreciation. Exchange rate changes will result in immediate adjustments in the price of traded goods as well as in the demand for import and export. These changes will immediately correct the trade imbalance. I think this we have done already. Just now I explained the same thing. So statement number 2 was, questions, it was related with question 7. We have already dealt. Come to the next paragraph. McFadden next addresses the influence of monetary and fiscal policy on exchange rates. Now story again changing. They are talking about monetary and fiscal policy. monetary policy is related with money supply in the economy. How the government is increasing and decreasing money supply, that policy. And fiscal policy means the policy to spend money by the government on infrastructural development of the country. And tax policy, how to increase or decrease the tax rates. Okay, that is fiscal policy. So here they are going to discuss how monetary policy and fiscal policy going to affect exchange rates. Clear? So countries also exert significant influence on exchange rates through both the initial mix of their fiscal and monetary policies and also by subsequent adjustments to those policies. It means they are saying once you design your policy initially and later on when you make changes to those policies, both the things are affecting foreign exchange rates. Okay? Various models have been developed to identify how these policies affect exchange rates. The Mundell-Fleming model addresses how changes in both fiscal and monetary policies affect interest rates and ultimately exchange rates in short term. So that model explains you, that is given I think in lecture. So McFadden describes monetary models by stating, statement number 3, monetary models of exchange rate determination focus on the effect of inflation, price level changes and risk premium adjustments. Stop reading now, okay? Come to question number 8. What is the least appropriate factor used to describe the type of models mentioned in statement number 3? So basically they had a word about inflation and also had a word about something else, other factors as well. They discuss very less one factor, that is portfolio balanced model. This was the least discussed in that model. Portfolio balance model addressed the impact of sustained fiscal policy on exchange rates, but this model is more closely related with risk premium actually. See, in any country people are making, they are diversifying their portfolio basically. Sometimes they are making investment at national level and sometimes at international level. Many of them are having combination of both domestic investment and international investments, and they are holding their investment only till the time until they are compensated well. The moment they think that they are not getting their compensation well according to market or according to the risk which they are carrying, they immediately sell their investment, get their money and try to park their money somewhere else. Is it clear? So this factor was the least discussed in that model. Which one? Portfolio balanced approach. People are balancing their portfolio by shuffling their investment from one place to other place. Is it clear? Then come to next part. McFadden continues her discussion